All right, everybody, welcome back to our How Do You Invest, Flip, Build, Buy, Renovate series.
Buy and hold.
Where we talk about basically you investing in real estate and how you're going to do that. And now we are at the mechanism. We've talked a little bit about budgeting, and now we're going to do the real nuts and bolts. How do you pay for a real estate investment? And so today we're talking basically about an intro to construction loans.
Yep. This is important stuff, guys.
So construction loans are not like your traditional mortgage. They last for a much shorter time period. They have higher interest rates, partially because of that, partially because of the increased risk. And they also cover, like the builder is going to be the one who gets this money and does something with it rather than the owner getting that money to purchase the house. So we are going to basically talk to you about, I guess, some of the big types of loans, and then Chris is going to cover basically closing costs, some thoughts on those, some good strategies, and just, I guess, dive more into the construction cost world.
Yeah.
All right, so let's jump in. So the first thing are, what are the different types of construction loans? So the first one we think of, which is sort of the one most people kind of assume, is a construction to permanent loan. This is where your construction loan basically rolls into becoming a permanent loan at the end. There's also a construction only loan where you are going to just pay off the construction loan at the end. They're just loaning you the money for that process and you pay them back when the construction is done. There's also a slightly different version of a construction loan where it's more of a renovation loan. So those, the renovation costs get wrapped up into the mortgage. And so those are things like the Fannie Mae Home Style, the FHA 203K loan. Those are some of the most common ones.
And you'd be using that at acquisition.
Mm-hmm. Correct, yes. And so your lender's gonna wanna see your information, your finances, of course, but also who you choose as a builder is important. They're going to want to know who that builder is, what's their reputation, how many projects have they done? Do they have a detailed budget? Do they have a start and end goal? What have they done before? So they're going to be looking at all of that, and they are going to want to review your plans. So if you thought you were just going to be winging this, no, you will be hiring an architect who will be designing it, whose plans will be used to, be evaluated by the bank to make sure that this is a reasonable thing to do.
Which, an interesting point to that is oftentimes the lender will tell you, you just roll your soft costs into the construction loan. But if you need your plans in advance of getting the loan, most likely what's going to happen is you're going to pay the architect out of pocket because they won't reimburse after the fact for expenses that were incurred prior to the loan being in place. So it's just sort of an important thing to keep in mind that you're going to have to front some of that cost out of your own pocket.
Right. And we also have to keep in mind, how much is this house going to appraise for at the end of the project? And that's something that they're going to want to know and look at. So obviously you're talking about predicting something in the future, but it still has to be based on data.
Yeah, and you're going to be looking at sort of an appraisal process, right? So they're going to send an appraiser out there to appraise it in its current value and then a projected future value. And then when you're done to close the loan, most of the time they send the same appraiser, hopefully the same appraiser, back out to say that you actually achieved the value that you needed to.
Correct. All right, so do you want to jump into talking about a little bit about closing costs and sort of wrapping them into the loan and some of the tips and tricks and things that you did when you were working on your project?
Yeah, absolutely. So this is something that you can do both just for an acquisition and also for an acquisition construction. So one of the ways that we were able to actually fund a lot of our closing costs is we took a Fannie Mae Home Style loan as our acquisition for our current owner-occupied property, and then we folded into that a $250,000 renovation budget. And of that, we knew that because it was a Fannie Mae product, it has PMI for the entire life of the loan. And we did not want to be paying that almost $400 a month in PMI. Once we were done with the loan, we knew it would appraise enough that we would be able to, in a conventional loan, be able to get out of the PMI. So knowing that we were going to refinance in about 12 months, we decided to actually take a higher interest rate, and then the bank paid us back in origination points. We made almost $12,000 for that, and we're able to fund the majority of our closing costs. So that's one of the ways when you're trying to think about how you're saving cash, which is something that's really important when you're undertaking a construction project, that you can do that. One of the other ways is if you're buying the property, you can approach the seller with a purchase price that folds in your closing costs. So asking for that seller credit back, usually capped at about 3%. That's something you can do. It's a little bit tough, right? So you have to do it the right way. We weren't able to do it on ours because we were coming in with such a low price. There was no way we could then also ask for 3% back. But if you were looking at a property like a lot of the properties now, since there's so little inventory on the market, you're not going to be getting some amazing deal off the purchase price. So maybe what you do is you go in at list and then ask for the 3% back, or you even go in at list plus the 3% and ask for the 3% back, so that they are like, okay, we're getting our list price and you're still able to finance in your closing costs. And that way you can hold on to that cash, because like I said, some of the stuff you have to fund up front, and you definitely want to have a hefty emergency contingency fund in there of your own funds in order to, number one, do some things that maybe weren't originally in the budget but make sense at the time, or number two, help you out if you run into a problem, because with construction loans, you can't come back after the fact. Like, this is the amount of money they're going to give you, and if you run into massive termite damage and have to replace all your joists, that's your problem, not theirs.
Mm-hmm. I think also something to keep in mind is if you're using this as a construction loan, you're thinking a 20-30% down. Whereas if you're going to be moving in and occupying it, and you can do this FHA style where you can maybe put 3.5% down, it's a very different amount of cash needed in order to do this process. So if you're not going to be living there, if this isn't a true investment property, then you are obviously coming in with a lot more down. Whereas if this is something where you're going to move in, renovate it, live with it, and sell it down the road later, that's a completely different process. So depending on which kind of investment this is.
Yeah, but again, I would really urge you to think about those government products with the idea of refinancing out once your construction is done, because if you've done it right, you should easily appraise for a conventional loan and be able to flip out of those products. But there are some real benefits, like the low down payment, and then also sort of the way they structure the loans, that can be of real benefit to you compared to a conventional loan.
Definitely. All right, so do you want to talk a little bit about construction costs?
Yeah, so I've gotten a lot of questions from people about how do you estimate your construction costs. And I think one of the biggest hurdles for people is that they think they have to like have a really good relationship with a contractor, even to consider a project, in order to get a number and really feel like they're comfortable looking further down the line and like deeper into whether or not they want to undertake this project. But if you think about a developer or a flipper, or even a buy and hold person, what they generally base their costs on is not going into the property and making a list of every single thing that needs to be repaired, because you just don't have that level of transparency or time. But thinking about holistically how much work they want to do, what the square footage of that work is, and then applying a cost per square foot that is aligned with the market cost at the time. So one of the big numbers that really floats around in this area is basically somewhere between 180 and 220, depending on the level of finish you want for a full gut rehab. And then you kind of dial it back from there, right? If you're doing a kitchen and all your bathrooms, you're probably in that space. If you're really just doing, you know, like ripping up the floors and paint and things like that, you're dialing way back. If you're doing an addition, you're possibly going over and above that. So that gives you a starting off point, and it's a lot easier to find that information and do a rough calculation to understand whether or not you're going to recoup the value or can afford the house at the end of the day, so that you don't feel like you have to get down in the weeds right away and therefore don't undertake the project ultimately.
Right. So the next video, what we're going to do is we're going to bring in a lender to talk to us about, from a lender's perspective, what are they looking for from you when you're going to be coming in, so that you kind of know, okay, ahead of time, this is what I need to have researched, this is what I need to have planned, this is what I'm going to need just to have a conversation with the lender to see if this is feasible, and then this is what I need to actually close a loan. So we're going to bring in a lender to talk to us a little bit about that and down payment requirements for the different loans.
Awesome. Well, thanks for joining us, guys.
All right, see you next time.